Good afternoon and welcome to our last BörsenTalk on Mittag in 2023. My name is Danielle Reischuk. I'm a Senior ETFs and ETP Sales Manager here at Swiss Exchange. It is my great pleasure to welcome the Swiss and international investor community to this webinar. Make yourselves comfortable wherever you are, home office, or even traveling. Today's focus is on ETFs. What's driving their broad acceptance and what trends are emerging for the coming year? As the ETF market in Europe continues to evolve at an unprecedented pace, today's event shall be your gateway to understanding the driving forces behind it and finding your specific way through a maze of changes, trends, and innovations. From the rise of active ETFs to the integration of commodities and the resurgence of fixed income ETFs, our panel will explore the diverse trends shaping the future of ETFs. The panel will dive deep into the transformation of trading dynamics within the ETF space, with a particular focus on retail investments, challenges around T+1 settlement, and other regulatory developments, offering you a full spectrum of the current trading landscape. On top of this, our knowledgeable speakers will provide an exclusive sneak peek into what 2024 holds for the ETF landscape. I welcome you once again to today's BörsenTalk on Mittag webinar. Before we start, I would like to inform you about some housekeeping. If you have been part of our previous webinars, then you know already that we use Slido to capture your questions. So please take your computer or smartphone and go to slido.com and put in BörsenTalk 23. I prepared a poll just to see that we are all on the same page. So please let us know if you are already invested in ETFs. We're excited to know. If you have any questions during the course of the webinar, please use the Q&A area and type in your question. The panel will answer some of these questions during the discussion. This webinar will be recorded and made available to you in the next few days to watch part of it or the whole webinar again. So now enough talking. Let's get started with the webinar, Navigating the ETF Ecosystem. Where does the journey take us? Please, Henry, the stage is yours. Henry, I believe you're still muted. Please unmute yourself.
Hi, thanks for Danielle. Sorry. Again, good morning, everyone, and welcome and thank you for joining us for this edition of the Swiss 6 BörsenTalk at Mittag. The topic of today's webinar is, as Danielle mentioned, navigating the ETF ecosystem, where we're going to talk about the current state of the ETF industry with a focus on Europe and discuss where developments in the ETF product, capital markets, and distribution will take us in the coming months and years. My name is Henry Jim, and I'll be your moderator today. I've been in the ETF industry since 2000, first as a trader and then as an ETF product developer at State Street Spider ETFs, BlackRock iShares ETFs, and JP Morgan. Currently, I'm an ETF analyst at Bloomberg Intelligence, the research unit of Bloomberg, the data, news, index, and information company. So I'd like to set the stage for today's webinar with some European industry figures. May I see the slides, please? Excuse me, are the slides being displayed here? Shared? Oh, thank you. So first of all, it's the number of ETFs has been growing quite a bit. We have 1,978 ETFs with 57 issuers in Europe, with a total of 1.5 trillion euros in assets, generating revenue of 3 billion euros. The flows last year were 80 billion euros. However, that's a bit of a drop since we breached 100 billion already in 2019. Next click, please. And year to date, these are figures from September. It's 100 billion, but we've already, as of last week, reached 125 billion. So we're on a pretty good record year. And finally, turnover last year, this is a BörsenTalk after all, was 3.1 trillion euros. And year to date, we're at 1.6. We might not reach that number, but it's still pretty good. Okay. Next slide, please. So where are all these flows going? As of June, we saw that even though fixed income ETFs made up only 25% of the assets in European ETFs, they accounted for 50% of the flows. All right, so we're seeing a lot of flows going by asset class into fixed income. What that means from a product perspective, though, is that investors are seeing bond ETFs not just as an investment vehicle anymore. They're seeing it also as a trading vehicle as more flows come in. However, we'll talk about this in our discussion, but we've also seen a reversal in those flows. Once again, using bond ETFs as a trading vehicle rather than just an investment vehicle, and that might has something to do with the current state of economic affairs. But I leave that to smarter people on the panel to talk about. Next slide, please. For my final slide, next slide, please. For the final slide, we take a look at the overall industry in Europe. We see that as of 2008, there were only 14 issuers. Well, actually, there might have been 15 with Credit Suisse, but now there are 57. I've only captured the top 50 here. And the takeaway from this slide is that over the past 15 years, there is some movement in the rankings, meaning that the industry is still evolving and growing. There's still room to move around. I like to call out ZKB, Zurich Cantonal Bank, and also UBS, local heroes in Switzerland. ZKB has fallen from 4 to 12, but that's not because they've lost assets, it's because they haven't grown as fast as the other ones. I think they currently have almost 100 billion, including the precious metal ETFs that they acquired from GAM, which was originally Julius Baer ETFs. And for our guest today, we have from iShares, from AXA Investment Management, and from Invesco. They're on this ranking as well. AXA is currently number 44, but ranking 23, but it's just entered, so there's still room to grow. iShares have always dominated in the number one since they were the first in the industry, and they have a good combination of product, capital markets, and distribution. And Invesco is holding very steady at 7 with a very broad and diverse product range. Okay, and with that, can I have the poll, please? I've just shown you how many ETFs are currently in Europe, but how many does the audience think have been launched in Europe year to date? If you could please go to Slido and enter your answers, please. Let's get a gauge of what the audience thinks, how fast we're growing in Europe. Oh, well, I was thinking that the audience is shy, but I've tried to vote as well, just to test it out, and something went wrong. Okay, well, we'll carry on then. The answer is 125 actual ETFs. So that's we're looking to reach about 150 by the end of this year. So that's about close to 8% growth year to date, so year on year. I guess the takeaway from my 3 slides are the ETF industry in Europe is large and growing. It's dynamic with new players coming in and rankings changing. And what we'll be discussing today is it's evolving with new products and the regulations that surround the products. Okay. All right. I'd like to take this opportunity to introduce our speakers today. First, we have Mr. Karim Shadid from iShares, Head of Investment Strategy at iShares. Olivier Paquier from AXA Investment Managers, Global Head of ETF Sales. And Mr. Matthew Tagliani from Invesco, Head of Product and Sales. Quite a stellar lineup today. So good morning, gentlemen. And thank you for speaking here on today's webinar. As I mentioned in the intro, I'd like to talk about the ETF industry in Europe along the lines of investment strategy or product, what the ETFs invest in, what they do, capital markets, the liquidity, how they trade it. This is a BörsenTalk after all. And finally, about distribution, what or like who is actually investing it and how it's changing. Okay, so perhaps we start with Mr. Karim, if you don't mind. Um, I think one theme that has been fairly topical in the past year has been ESG. We've seen a big political and social backlash against ESG investments in the US. There's been some confusion in terms of terminology in Europe, but where do you see the current state of ESG investment is in Europe or globally, and where do you think it's going? And I'm going to open this up to the other two speakers as well. Sorry, Mr. Shadid.
Absolutely. Thank you so much for having me on this call, and really happy to be sharing some perspectives from us here at iShares. And starting with your question, I would say that the past couple of years have been really interesting for the sustainable space. So we had in 2022 pretty difficult performance year when we had energy rallying, and some of the performance challenges in ESG have given us in the past couple of years some case studies to look at. And I think the important thing here is to really understand the performance of these benchmarks. So we've done a lot of work to think about how the performance within ESG benchmarks gets broken down. So if you look at the ESG factor, it remains a positive return contributor throughout different periods of performance, regardless of what's happening in the broader market. And that's really key, because it means that you start to understand some of the sector biases in the range. For example, a tech bias upwards, or an energy bias downwards. So tech overweight or energy underweight are performance detractors or performance contributors, but then they are sector. You understand them through the lens of sector biases, as opposed to anything else. And so as you understand them better, you look under the hood, you understand the portfolio, you can choose to neutralize some of these biases. So that's my first takeaway. The second is really around how to evolve the conversation when it comes to sustainable investing beyond ESG to the broader transition. And this has been a big theme for us. You mentioned that 125 new products were launched in the ETF space in Europe this year. You will see that within those categories, you will see that a lot of products are focused on the transition investing. For example, transition metals such as battery metals, copper miners, lithium miners, battery storage, these types of exposures that help as inputs into the transition to net zero. And I think as we move forward to 2024, the conversation will really broaden to talk about the opportunity set in transition investing as really a longer term investment opportunity.
Okay, well, thank you. So you're talking about performance as one guide to seeing how ESG ETFs are doing, but then you also have sustainable investing, which is sort of a move away from the S and the G, perhaps. So it's performance and product. How about you, Olivier? May I call on you? What do you think? Was it performance, or is it more of a investor attitude towards ESG investing? What are they looking at?
Thanks, Henry, and thanks for having me today. I'm very excited to be here. In fact, this is a question that we definitely looked at AXA Investment Managers. We are a new ETF player. We're 1 year old, so we are. I believe we've been bathed into the ESG topic since day one. Maybe to a beginning of an answer to your question, Henry, is quite, I would say, is quite simple. Danielle, in the introduction, talked about the transformation of the ETF landscape and the adaptation of products following regulation, but also investors' needs. In my view, ESG is paramount in that transformation of the ETF landscape itself for a few years, particularly since 2001. And you mentioned 125 billion euros. It's gigantic amount of net new assets in the ETF industry, record-breaking for the European industry as a whole. And it's interesting to see that ESG overall, or sustainability, represents about 30% of those flows. The interesting portion, since we remained on 125 in terms of products this time, new products launched this year, is that 90% of those, 90% of those, are exposed to anything ESG related. So it comforts me in saying that it definitely is a client/investors demand. This is in that direction that we've gone through at AXA Investment Managers. And we've gone one step beyond this because one thing that is emerging as well is actively managed ETFs, which tend to blend very well with ESG, to pour out of exclusions and inclusions, but also to go into some convictions and trying to fuel the what we call the operational leaders, those who have I would say, a maximum impact to the portfolio. So that's one portion of the answer, I would say.
Okay, thank you, Olivier. Okay, so it's about the investment breakdown. It's about the product. Matthew, may I call on you? What's your take on ESG investing? If performance was one factor, and then factors is another, what other elements of ESG or sustainable investing do you see as taking place right now in Europe, and where it's going next year?
Well, yeah, I think there's ESG's probably the richest kind of field as it is right now in ETFs, in terms of we go back 4 or 5 years, and the level of investor understanding, the level of sophistication of clients was much lower. And what we find is that the conversation in the last 24 months has become much more nuanced and much more clear in terms of clients trying to identify what their specific objectives are. One of the challenges, I think, and Karim alluded to this, I think going back a couple of years, you had a multi-year underperformance of the energy sector, which basically made jumping into ESG easy. It was, you were underweight energy, your ESG funds outperformed, and people, there was a kind of a structural shift into that space. But a lot of clients, I think, went in, we were still digesting SFDR, we're still digesting a lot of kind of the new regulations, and clients had a much less nuanced understanding of what it was that they were actually investing in. And what we've seen is over the last kind of 12 to 24 months, a huge increase in the sophistication of client questions, the level of understanding that they're looking to get. I think some of them have moved back a bit from this sort of knee-jerk Article 8, Article 9 classifications, kind of as treating that as a label, and instead of kind of really starting to look at where on this spectrum from you have the traditional benchmarks which don't incorporate ESG, all the way over to what we would refer to as your sort of dark green, SRI level, or even Paris alignment. Where do they want to sit on that sort of spectrum? And for us, that's it's been hugely comforting, because we're always much more comfortable, the more confident we are that clients are really digging into the strategies that they're investing in. We want to make sure that people feel fully confident that they know what they're getting, they understand what the risks are. If there's a sector weight bias, make sure they know that, because that's going to be a significant driver for performance potentially. I think the other bit that we've seen pick up a lot in the last sort of 18 to 24 months is, as you alluded to, is the shift towards sort of climate centricity in the strategies that people look for. And again, it's been a great kind of fertile ground to come up with a lot of interesting conversations. Clients who may have had particular standards that they established in terms of ESG score, ESG rating, degree of exclusions, that now suddenly want to start incorporating climate and realize that taking a Paris aligned strategy and taking a sort of high degree of exclusions, like an SRI level of exclusions, you're starting to constrain your portfolio too much, and so you need to start becoming flexible on one side or the other. Those kind of nuanced details that may not necessarily be available, may not be observable right from the surface, I think have been a great source for conversation for us. And we've seen no slowdown. Whereas the US has become very politicized, in Europe, things have sort of steady the course, as it were, in terms of more and more clients just incorporating ESG as just part of their standard investment process and not treating it as something different from kind of their core. Oh, you're on mute.
Thanks, Matthew. So from the discussion, it seems like ESG still has a good grounding in Europe, perhaps a little more so than in the US, and there's still good flows going to them. Although I think when you said 30% of flows, Olivier, it might be, from my research, it seemed like it might be part of that might be by default because there's a lot of products that are being launched based on these indices. However, I think the future is still bright for ESG. My hypothesis, my thesis is that as you mentioned, Matthew, as the investors become more nuanced or more understanding, we'll see more specific environmental strategies, not so much on the social and governance, right? And as Karim mentioned, investors will be looking more at the factors contributing to the performance of the products and not just the labels, right? And that brings me into the second theme, appropriately, thematics. Because as we move away, as we evolve from ESG, from what I'm seeing in my research, a lot of investors are now looking at specific strategies. First, it was like items like electric vehicle infrastructure has an ESG environmental skew, if you will. But then they also evolve into other themes like AI, robotics, etc. So what do you, Karim, I'm going to ask you maybe, what do you think is the way to approach thematics such as these, and how do they fit into a portfolio, and who do you think is buying them? Is it more retail, or can you share your thoughts, please, both from a product and distribution perspective?
It's a great question, and I think I alluded to it in the answer to my first question on sustainability when I spoke about the battery metals, because this is an area in thematics that we think is a really key area to focus on over the next couple of years, especially as the supply-demand imbalance means that there's a lot more demand for these types of metals that will power the transition than there is supply, and also the battery storage that I mentioned earlier as well. Beyond these, I think AI, you already mentioned, AI has already been a significant asset allocation driver for markets in 2023, where we've had more than 90% of the returns in the S&P 500 driven by just 7 stocks, and those would have all been related to AI in some shape or form. But it's more than just a sentiment frenzy. We are seeing a real boost to earnings coming from this theme. So if you look at the earnings season that's wrapping up now, Q3 earnings season that's wrapping up now in the US and Europe, you'll see that AI has had a real boost to earnings numbers in US companies, especially the large caps. Now, we have identified something we call the tech stack, which is really looking at AI from across the output, the client-facing side, such as the chat GPT or generative AI, and through to the hardware that powers AI, such as semiconductors and chips. And so I think there are investment opportunities across multiple points in that stack. We've only scratched the surface this year with regards to the sentiment around some of the more software side. But as you think about the hardware, like semiconductors, I think there's room to run on these investments. And these are only 2 topics. If we think more broadly, at BlackRock and in iShares, we've identified 5 mega forces that we think will be key to asset allocation over the coming years and key to thematic investing. And those mega forces, AI is 1, transition is 2. So we already spoke about 2 of them, but there are 3 others that we're looking at. The future of finance, which looks at things like the role of private markets and private credit as in lending, as the role of banks scales back somewhat. And the last 2 are geopolitical fragmentation, or what we otherwise call the rewiring of supply chains, And here there are things to look at in terms of emerging markets that could benefit from these types of supply chain rewirings. And then lastly, aging populations, so the demographic problem and what opportunities could lie there. And I think it's important to frame these mega forces in the context of investment opportunities as opposed to just risks. So thinking of who the beneficiaries from these different structural themes could be and how to invest in them. And so that's the framework we're following as we think of thematic investment over the next few years. And then to comment on your question about who's buying these types of exposures, I think it's a mix of everything. Certainly, they have been popular within the private bank and wealth space, so more on the retail and intermediated side in wealth. But also there are applications in institutional investor portfolios, especially on the satellite level. So I wouldn't say it's just one segment.
Okay, thank you, Karim. Actually, before I continue with the other speakers, there's a poll up, and thank you for answering. For those who haven't completed the poll, please take a look on Slido. The question is, which type of ETF strategy do you think will capture the most flows in the next 6 months within Europe? The poll is still live. The 4 actively managed fixed income commodities and thematic are still competing. It's like a horse race. We'll address this after finishing the discussion on this theme to see where we lie in the numbers. So in continuing with Olivier on the theme of thematics, if you will, as Karim said, it's his iShares has now 5 mega forces, and I would call these thematics myself. What is AXA's approach to thematics? And what do you see the future? Who's investing in it? And even more importantly for this talk is why in ETFs, right? We're talking about performance, we talk about the investors, but there's different ways of investing in thematics. So if you can roll that all up like into your answer, that'd be great.
Okay, thanks, Henry. Sorry, I get very distracted by the result of the poll. This is fascinating because I would combine actively managed with fixed income as well. They're not opposed, obviously. So there's something reassuring about the result. So the way we've looked at thematic ETFs historically, and we may have a slightly different view. Being an affiliate of an insurance company or an insurance group, if you will, is highly related to the climate evolution, and planet Earth in general. We do have a vested interest, obviously, in ensuring our clients against any climate-related risks. So the way we looked at it was slightly different. We didn't choose a specific type of index or exposure, but we looked at it through the lens of the United Nations Sustainable Development Goals, so the UN SDGs, for those who are familiar with this. And the idea that we had was to go one step beyond, and this is really in line with what our institutional investors, our institutional base of investors was expecting from us, was to provide an easy to access solution, to answer your question, Henry, to companies that were, I would say, pushing the envelope to provide solutions, so solution providers, in, for example, the biodiversity sphere or in the climate-related theme, as well as with companies who were structurally bringing a change, so impacting the portfolios the most, both in terms of performance, but also in terms of change for the theme, which we call the operational leaders. So the solution providers and the operational leaders. And when you combine them, you've got something quite powerful in terms of impact on the portfolio, in terms of impact on the biodiversity one, for example. And the way we distribute it, I would say, I mean, the philosophy behind and the way we looked at it is pretty much the same as what we have on mutual funds. So the same investment strategies in the background, the same, I would say, intellectual property. The only difference would be the wrapper itself, where we would distribute our strategy through probably a broader set of clients and in an easier way. Because as we know, with an ETF, you only need one share, mostly for retail investors to invest. And this makes this type of strategies highly accessible to a vast majority of clients. That would be the main difference, in my view. But same constraints with the liquidity and the transparency added to it.
Okay, that's very clear about solution providers and operational leaders. Thank you. And but in terms, Matthew, now, do you agree that if it's through an ETF wrapper, it's more accessible? Does that necessarily mean it's more of a retail product then, or how do you Invesco see this?
Yeah, well, I think I don't necessarily think it specifically aligns to retail. I think to my mind, the ETF wrapper is, I think, has sort of established itself over the last sort of 5 to 10 years, obviously to a tremendous degree in the US and to an increasing degree in Europe as kind of it's a slightly more client-friendly delivery mechanism in terms of transparency, liquidity, all of the kind of the benefits I think most people will be aware of. So I think with the growth of thematics, to take a thematic, a sort of very new, innovative, some driver, something which is happening in the market today, which isn't correctly captured by pre-existing products, it's just natural to wrap it in the most sort of new, sophisticated, client-friendly vehicle. And so I think the coincidence of thematics with ETFs is more about a new thing in a new vehicle, as opposed to taking sort of the new exciting thing and then wrapping it into a vehicle that's been around for 40 years and may just not have whether from a tax perspective or from a sort of overall efficiency perspective. But I think your point about thematics in terms of, and again back to some of what Karim said, I think the growth there, the way we see it is, in the end, thematics are just kind of the logical extension of what is basically the basis for every index product out there, which is to try to identify some driver of differentiated return that is going to affect a select group of companies. And the simplest version of that would be a country index, being based in the United States versus being based in the UK or in Germany or in Switzerland. The next level would be sector. Companies that do similar things will experience similar fates. And what you're getting now is that as new technologies come along, as new trends occur in the market, you have new drivers that just don't align to the traditional country, currency, sector, market cap bucket that existed previously. So, while there's a huge amount of focus on thematics, in some sense, we view thematics as very much something which has always been here. 20 years ago, 30 years ago, sectors were effectively then what thematics are today. If you want to invest, you think banks are going to be affected by something, you want to buy a portfolio of banks. We look at it and say, now a driver could be the growth of, new energy, solar, wind, hydrogen, these sorts of things. Those could be drivers of differentiated performance for a select group of companies. And the only thing that's new is that they might cut across different market cap, country, and sector classifications that we've had traditionally. And where we've seen a lot of interest from clients is actually, I think, a lot of the most interesting thematics that have come out in the last few years have been very ESG related, but we've actually seen a huge amount of interest from clients which aren't necessarily investing for the ESG characteristic, but rather just based on the thesis. So you can invest in solar energy because you think solar energy is a good thing that you want to provide effectively financial support to those companies. Or you can say, I want to invest in solar energy because I think that governments around the world need to find new sources of energy, and there's going to be a huge amount of investment in this space. So it's quite fascinating to me that when we talk about thematics, half the time we're having we're having conversations about what would be sort of ostensibly ESG thematics with clients that aren't making an investment for any sort of ESG reasons. They're looking at it from that sort of, this is a thing which is moving and I want to get exposure to that. And very much the way Karim put it, solar is a great example. You have people who are mining silica, you have people who are manufacturing photovoltaic cells, you have people who are setting up farms of solar farms, you have people who maintain those farms. it's a whole broad spectrum from sort of, the start to the finish of the thesis, all of which can be driven by this same overarching premise, which is an increase in solar. So you get these fascinating portfolios where you have a mining company, and you also have a services company, and you have a tech manufacturer, and you have a semiconductor or a software manufacturer who's driving the development of the tools behind all of this. And that's kind of, I think part of the exciting thing about thematics is just that you get to have such a rich breadth of conversations with clients about so many different things. And then, not even getting to the point of how we're going to actually implement this in a portfolio.
Thank you, Matthew. That's very interesting what you said about the sectors being the thematics of the in the past 30 years, because that would imply that right now we would need to have a more organized way of classifying themes and being able to quantify them, to be able to bucket all these companies and investments into thematics in order to have a proper taxonomy, which is something we're working on at Bloomberg right now, actually, is to be able to transparently classify each company in its particular theme, or show the percentage exposure to a particular theme, right?
And it's tricky if they're much more overlapping than traditional sort of sector classifications would be.
Exactly. So we're looking at revenues, and then also company filings, for example. I see Olivier Axe has taken the active route, but I think also we're going to need a more overarching, commonly accepted way of classifying themes. Absolutely. And in terms of ETFs, my particular take is that the ETF wrapper is the way to go, because as you have a modular family of themes, you have ETFs which are more relatively easy to go in and out as you construct your portfolio, and you can see where they fit. That's a fascinating theme, if you don't mind the pun. Moving along to capital markets, a pressing theme, or a very big theme, two very big themes in ETF industry right now are the consolidated tape in Europe, and also T+1 settlement in the US, and how it's going to affect European ETFs. Olivier, maybe I start with you. We've talked about this before. Let's start with the consolidated tape. When do you see this happening, and how do you think it will affect ETF trading, liquidity, uptake by investors?
This is actually a topic that I'm sure will be of interest for the audience today, as this keeps coming back in various client conversations. I think, Matt, you were talking about very rich client conversations, and clearly this is one of the topics that animates a lot of our clients and a lot of our investors overall. So first of all of this, as we if we take a more helicopter view, is part of a natural, in my view, evolution of the ecosystem. So it's less of an evolution from clients directly, but it's clearly an evolution from the ecosystem to bring transparency and clearly clarity and the quality on the data that is not available yet on the execution of ETFs in general. So we're talking about at what price are they being executed. We're talking about at what size are we, on each transaction should report, and the timing of those transactions. So three elements that most, I would say, players on the market, not necessarily end investors, but most players on the market need to know and understand on the ETF market in Europe in order to provide a real-time, better service, I would say, in terms of transactioning or trading, if you will. So in June, just to be very clear with everybody, in June this year, the European Commission, Parliament, and the European Council for once have agreed to set a standard and to report real-time trade transactions, so pre and post-trade data. That is, I know this is very jargonic for many people on this call, but basically this means that this will bring transparency and quality of data to the operators on the market. So the brokers, the trading firms, the dealing desks, the asset managers as well. And this will help to apprehend the real liquidity of an ETF. I get the question very often out of all of this. What's the liquidity? What's the real liquidity of that ETF? And that's frustrating sometimes not to be able to explain it entirely. And I believe that this consolidated tape that we're putting in place, which should at this point become mandatory by 2025, that's my understanding, should improve those questions, or at least the quality of the answers to those questions. So on the price, the size, and the timing of the transactions. Ultimately, we've seen a few providers already starting to publish aggregated data. So on exchange trading, including outside of the EU, by the way, trading. I'm thinking of the UK and Switzerland, as we are on the BörsenTalk in Switzerland today. Over-the-counter transactions, off-exchange transactions, all of this being put together, added, aggregated, and made transparent for end investors. And I believe this is clearly the path and the way for the future. And that's a great adaptation, among others, of course, of the ETF industry. I was very jealous personally for many years of the US market, very transparent, very easy to understand, I would say, and very organized. And I think we're getting there. Just for investors on this call, this should apply to UCITS ETFs, so EU-regulated ETFs, which are becoming the global standard in the ETF industry. So it will be relevant not only for clients within the EU, but elsewhere, over here in Switzerland as well. I'm thinking of clients based in Latin America or Asia as well. I pause here because I'm sure Matt has a lot to add.
But before you go, before I call on you, Matt, I should have mentioned to those who are not familiar with the consolidated tape concept, what's happening right now is in the US, there are 3 major exchanges, stock exchanges, where ETFs are listed. And every day you can see the total bids and asks and prices for these ETFs. Whereas in Europe, it's fragmented, and meaning that every exchange has their own bid-ask prices and volume, plus there's a lot of off-exchange activity. So what that means for the investor is the ETF investor in Europe does not see the full potential or actual liquidity in an ETF. What the consolidated tape does is it consolidates all the different feeds into one single consolidated tape, so that an ETF investor can, at one glance, see in real time where the market is and how deep it is. And that's the theory, anyway. Right.
And maybe we will finally use the E and the T to its full potential of the ETF wrapper.
And with that, Matthew, what are your thoughts on the consolidated tape? Do you see it as positive, negative? I think it's positive, but what are your thoughts, where it's going, developments, and how Invesco is approaching consolidated tape?
Well, I mean, as any of you might have guessed from my accent, I grew up in the States. That's my, I spent the first part of my career there. So yeah, the consolidated tape was just the standard, and you never thought twice about it. It was just the way things were. Subsequently in Europe, that challenge of always having to explain to clients there's more liquidity than you think, these things turn over much more, all of those issues around transparency, which are kind of so integral to the idea of the ETF, which is all about transparency, democratization of investment, effectively one product for all investor types. And I think it's unquestionably a positive, and it's a direction which Europe has been moving in, and there's really no there's no strong justification in terms of pushing back on it. It's just a clear benefit to investors. So I think that is a hugely positive step that we welcome. And I think to your other point about T+1 trading in the US, this is something which I've been actually quite surprised in client meetings, the degree to which clients who might not have otherwise expected it from have been quite sort of curious about this, thinking about it. And it goes back to one of the advantages of the ETF structure, which is that the interaction with the fund itself is intermediated by the authorized participant community, who are large, sophisticated investors, that then feed on to the end retail or the end investor in the fund, be it retail, institutional, or otherwise. And fortunately, I think dealing with T+1 settlement requires a lot of reconsideration of some of the trading logistics. There's some impact that it may have in terms of, when do you need to submit an order, if it needs to be executed, if it's a global portfolio, that sort of thing. But fortunately, what it does is the ETF structure centralizes all of those challenges with a community of the most sophisticated market participants out there. So from all the conversations that I've had with our capital markets team and in speaking out with clients, and regulators as well, I don't think there's a tremendous concern. There are a few things that will be impacted. If the people who are actually trading the underlying portfolio and delivering it to the fund, if they have to trade some parts of it with 1-day settlement, some parts of it with 2-day settlement, there can be portions of that need to be funded, where they need to basically they need cash in order to settle. It may mean that certain trades that you would do historically at today's NAV, you might be executing them at tomorrow's NAV and submitting the order today. But nobody seems to be, it's a bit of work. It's going to require some people to kind of move around some of their trading processes, but fundamentally, there doesn't seem to be any concern on the part of any of the major market participants that we've spoken with in terms of, will this have a detrimental impact on liquidity? Will this be negative for pricing? It will cause some changes, but again, to another state of the world, which is in no way sort of materially worse than our current.
Before we go on, Slido is now open for questions. We still have a few minutes left, so if the audience could please type in your questions, and we'll address them after Karim puts his thoughts on consolidated tape and T+1. And specifically, my question for you, Karim, is how does these liquidity issues and parent or otherwise, like T+1 and consolidated tape, does that factor into the asset allocation decisions made by your investors or your calculations?
Yeah, I think it definitely does. One example that I would give on this is, sorry, I can hear an echo. If you don't mind going on mute, if you're not speaking, that would be great. Thank you. I think that that comes in really clearly in areas where we have seen the evolution of the ecosystem around what we call the moat around ETF. So take, for example, gold ETCs in Europe. They have advanced a lot in terms of liquidity, in terms of size, and also in terms of the availability of things like options on ETFs. And as that has evolved, we've seen the way that investors, ETF users, use those ETFs evolve as well. So we've seen significant amounts of option strategies on our gold ETC in the last couple of months for downside hedge strategies, for example, gold puts, rather than for those who already own gold, or gold calls for those who want to put on a gold hedge but don't want to buy it Delta One, don't want to buy it outright because of the mixed conviction around gold performing in an environment where real rates are high, but they still want the gold position because of the geopolitical risk that remains elevated. And so in that type of, because of the availability of more liquidity on ETFs and more liquidity on options on ETFs, this has become an available tool that investors have used. So we definitely see asset allocation trends evolve as the ETF ecosystem evolves. And similarly with consolidated tape, as we get more consolidation of tape across the more fragmented, and I wholeheartedly agree with the comments with both my co-panelists have provided in comparison between the fragmentation in Europe versus the given consolidation tape in the US. But as we get more towards a consolidated tape, we get more information, more transparency, more economies of scale in Europe, and I think that will only benefit the implementation of asset allocation decisions and asset allocation through ETF use in Europe. So I'm optimistic.
Okay, thank you. And here, no, that makes sense. Of course, liquidity will impact asset allocation. But here's a question from the audience, actually, that goes across capital markets product and distribution. will we see higher TER, total expense ratio, of ETFs due to this US moving to T+1? What do the panelists think? I think I'll ask Matthew first, if you don't mind.
So it should not impact the expense ratios, and in general, raising expense ratios structurally is very difficult. It usually requires a shareholder vote. So most shareholders don't vote in favor of higher fees. No, what you may see is a slight shifting in the bid and offer spreads, but these are things which you're talking about the funding costs of a portfolio over one day. So you're literally talking at the sort of single-digit basis points of impact. So we don't expect it to have any material impact on either liquidity or pricing. You may see, again, it would be, if anything, a slight shifting up or down of the bid and offer spread. So it would be symmetric.
Okay. And another question, this one may be for Olivier, because you had mentioned flows into ESG ETFs or sustainable ETFs. It says inflows into sustainable ETFs will continue to fall. When will the turnaround come? Do you agree with that statement? And what are your thoughts about that?
That's a good question. So I think everything is quite relative in this world. So last year's flows were 100% on ESG exposures. If you looked at so 2022 was an ESG year. 2023 is a fixed income year, I would say, with some ESG flows. So I don't think there will be a turnaround in the future. I think there will be a continuation of the flows. Obviously, once the AUMs, the assets held by investors in ETFs is actually quite stable in Europe in particular, which means that the typical ETF user in Europe is a buy and hold type of client. What I believe more is a continuous innovation in that space with more unique strategies, more nuanced strategies fitting more investors' needs into that category, which should fuel over the long run more flows into ESGs and not a shift or a turnaround for sure.
Yeah, I agree. It'll be more focused investments where the flows will be going. Focus on environmental. That makes sense. Take another question from the audience. What impact do you expect neobanks to have on ETF trading? I'm assuming this question refers to the online banks and other more retail-focused banks, but also brokerages. Karim, do you have a view on that?
Not really. I'm happy to see if any of the other panelists have a strong view. I think
That's true.
I don't see a significant impact per se. I think it provides what they're doing is that they're providing more access to investments in ETFs. So I would expect that it would, especially with the increase in ownership through these types of partnerships, increase in ownership from retail investors, so really end investors and retail investors, there will be more access to ETFs for that market, and there will be a lower, the bar to invest will drop, which is only a good thing, because in Europe we still have a culture of savers, not investors, and I think this type of evolution will help shift that culture towards investments. And the US provides a good example of this because there the retail penetration in the ETF market is a lot higher. But I don't have a strong view on what impact that would have on ETF trading specifically. I just generally think it has impact on access.
Okay, thank you. Actually, this question, I will ask Matthew about this, because it seems your Invesco product lineup is more specific and diverse and geared towards perhaps the retailish type of clientele of these neobanks. Have you guys addressed it, or what do you think about it?
I think we view the banking side of this as it's sort of a subset. It falls under the broader umbrella of just the increased retail participation in Europe in investment in general, as Karim mentioned, as well as specifically in ETFs, and the growth of demand from retail, which is something which has always been sort of anticipated. There have been lots of efforts to sort of tap into it, and it's always been we know it's going to happen at some point. We're not quite sure when. It definitely feels like seeing some of the firms, especially on the continent as well as here in the UK, there's been rapid growth and adoption of, seeing ETFs much more as kind of, again, similar to that US model where you're no longer talking about a fund which has 20 investors, each of whom has a fairly large stake. You're talking about individual clients who in their kind of they get their paycheck, a certain amount goes into their account, and the amount of that is allocated to a portfolio of ETFs, those sort of ETF savings plans. The huge growth of that, the banking side just kind of sits alongside that, and so we view it kind of not as necessarily something that you would sort of have to differentiate one from the other. It's kind of all part of the same trend.
Interesting. Okay. All right. We only have a couple minutes left. We'll take one more question and then wrap up. This question, well, it's gone to count twice. It's a crypto question. BlackRock and Invesco, what do you expect an answer to your spot BTC Bitcoin ETF filings at the SEC? That's the US. And what do you think about crypto ETFs? Will this be a trend for the next years? Olivier, can I start with you?
I will have a very short answer. We will fuel innovation and we will fuel, I would say, new ideas, mostly in ESG and active exposures, but we're not going to tap into Bitcoin. So it's probably a question more for my peers on this call. Happy to pass over.
That's very clear. Thank you. Karim?
Not an area we're currently exploring in Europe, as what I'd say.
And we've got a product in Europe. Again, can't comment on the US filings, but obviously we have had a product, a Bitcoin tracker in Europe for about 1.5 years now. And I think it's just one more tool that allows certain investors who want to invest to have a vehicle that fits into what we view as fundamentally more actually an institutional type client, a larger client who can't just go out, open up a wallet and make an investment because they've got a risk system that things need to fit into. They have standards for valuation that they need to adhere to. So, crypto ETFs or crypto ETPs, as they would be in Europe, are really just about opening up investment into digital assets for investors who need to work within the existing framework of risk management systems and product control systems that they already have. And that's really where we've targeted our focus.
Okay, so it's about access again.
Exactly.
Okay.
Exactly.
Thank you. Well, we've reached the end of our time here. It was a great discussion. We talked about from investment strategy, talked about thematics and ESGs, about asset allocation. From a capital markets perspective, we talked about consolidated tape, T+1, liquidity, and finally, from a distribution, we actually touched a bit on in terms of the ETF savings plans and retail versus institutional markets for ETFs in Europe. So thank you very much. I do look forward to speaking to everyone again, and I pass it along to Danielle to wrap up. Thank you.
Thank you very much, Henry. Thank you, panel, for this very insightful discussion. A big thank you also to you, the audience, for the questions that we received, and I really hope that you enjoyed this webinar and that it gave you some food for thought. Our next BörsenTalk is planned for early next year, so please stay tuned for more information in due time. And please also let us know if you liked the panel and how you liked it, as we would be pleased to receive your feedback. With that, we close today's webinar. Thank you once again for your interest and time. Join us again. Thank you and have a successful trading day. Happy trading. Goodbye, everybody.